Dividends are a great form of passive income, and dividends get paid whether stocks go up or stocks go down. And dividends can work in your favor through utilizing the power of compounding. There is something special about seeing dividends hit your account on a regular basis, but it just hits differently when those dividends are coming in each and every month. And in today's video, we are going to be talking about 3 monthly paying dividend stocks that you could look into for your portfolio. And if you love dividends and want to hear more, then definitely smash that like button down below, subscribe to the channel, and let's get started. Hey everyone, Mark here, back for another video, and I think you're really going to like what I have in store for you today as we are going to be talking about monthly dividends. But before we begin, let me take a moment to thank today's sponsor, which is MooMoo. MooMoo is a commission-free trading platform owned by the NASDAQ-listed fintech company Futu, with over 19 million users across 200 countries and regions. Right now, MooMoo has an exciting Holiday Magic sweepstakes going on where you could win the top prize of $50,000 cash or 10 second place prizes of $1,000 cash. On top of that, if you open a new account and deposit on MooMoo using my unique link down in the description below, you can also receive up to 15 free stocks and $10 cash back. MooMoo is a solid brokerage with a lot of great tools, from stock screeners to heat maps. They also have free paper trading for those of you that are new to investing. But one tool that I use a lot is the institutional tracker, where you can track the likes of Warren Buffett's moves or someone like Ray Dalio. And if you are a more advanced investor and you use margin, MooMoo has one of the lowest margin rates out there with only 6.8%. So definitely take advantage of this special promotion. Link is down in the description below. Now let's get into the video discussing these 3 monthly paying dividend stocks. The first monthly dividend stock that we're going to look at today is Realty Income, stock ticker O. Realty Income is the gold standard when it comes to REITs, and they're actually one of the most popular REITs. They become popular due to their monthly dividend. They have coined themselves the monthly dividend company. Currently, shares of Realty Income have a market cap of $40 billion, and on the year, shares are down roughly 9%. The company operates in the net lease retail sector, and what that means by net lease is a lot of the typical landlord costs are passed on to the tenants. This includes property taxes, maintenance costs, insurance costs. These are all passed back on to the tenants. And when it comes to Realty Income, they are about as steady as they come. They provide consistent returns, high yield total returns, strong portfolio of properties, investment grade tenants, and a strong management team. Let's begin with the consistent results. Since going public in 1994, Realty Income has delivered compound average annual total shareholder return of 14.4%, outperforming both the US REIT sector as well as the S&P 500. In terms of the dividend yield, Realty Income pays a dividend yield of 4.6%. They have declared 628 consecutive monthly dividends, and they have 100 consecutive quarterly increases, making them a dividend aristocrat for having increased the dividend for 25 consecutive years and counting. In terms of tenants, Realty Income works with some of the best tenants around and some of the best companies on the market today, with 43% of their annual base rent coming from investment grade tenants. Here is a look at the company's top 20 tenants along with their industry exposure when it comes to their properties. You see names such as Dollar General, Walgreens, CVS, Walmart and Sam's Club, Home Depot, and Kroger, just to name a few within the top 20. You could see also over on the right side, grocery stores accounts for the highest weighting in terms of industry exposure, accounting for 10.3% of the company's annual base rent. Given the consistent results and strong portfolio and track record, Realty Income tends to trade at a premium when looking at the net lease retail sector. Realty Income over the past 5 years has traded at a price to AFFO of 20 times, which is the blue line you could see here when looking at this fast graphs chart. Right now, shares are actually trading below 17 times, suggesting shares are cheap when compared to recent history. So with Realty Income, you get a consistent company, a great company, led by a strong management team with consistent results, backed by an A-rated balance sheet. So definitely consider Realty Income for your monthly dividend paying stock. The second monthly dividend paying stock that we're going to look at today also happens to be a REIT, and it is Stag Industrial, stock ticker STAG. Stag Industrial operates as an industrial REIT, and currently the company has a market cap of $6 billion. On the year, shares of Stag are down over 30%. Stag has endured a much more difficult 2022 than Realty Income, but that has provided investors a great opportunity in this high-quality industrial REIT. The company recently reported their Q3 earnings, which were actually quite good. We saw strong performance, especially in the renewals segment. So we're getting a lot of tenants, instead of passing on and going elsewhere, they're actually renewing their contracts. And a lot of these contracts with Stag Industrial are long-gated contracts, many years, 10 plus years for Stag Industrial. But there's a big disconnect from the stock price and from how the company is operating. Now, there are headwinds for the business. I'm not denying that, but the upside is so much brighter, especially with stocks off their high of by 30% on the year. Here's a look at the company's top 10 tenants, which is led by Amazon, accounting for roughly 3% of the company's annual base rent. Stag Industrial also takes a major focus on the quality of tenants that they work with. In fact, 83% of the company's tenants have revenue in excess of $100 million, with 59% having revenues in excess of $1 billion. Given that Stag Industrial is an industrial REIT, much of their growth is predicated on the growth of e-commerce, which I believe is still in the infancy stages. Right now, e-commerce accounts for 14.5% of total retail sales in the US. That number is expected to reach 30% by the year 2030. We saw a huge spike during the pandemic, but things have settled back down, but this will continue to be a growth driver for the REIT moving forward. In terms of valuation, shares of Stag Industrial currently trade an AFFO multiple of 17 times, which is slightly below their 5-year average of 17.8 times. For comparison purposes, the premier industrial REIT, which is Prologis, stock ticker PLD, a REIT that I like very much, they trade at an AFFO multiple of 27 times. So Stag is at 17, PLD is at 27. This is just showing you the multiple expansion opportunity for shares of Stag. So definitely consider this industrial REIT for your monthly dividends. Now this is where I throw a wrench in things. We've talked about 2 individual stocks, but now this third option, we're going to be talking about an ETF. Individual stocks may not be for everyone, or maybe you're looking to broaden and diversify your portfolio with an ETF. So this third stock we're going to talk about is the JP Morgan Equity Premium ETF, stock ticker JEPI. JEPI is a newer ETF, having only been around for roughly 2 years. JEPI is not your average high yield dividend ETF where they just buy dividend stocks and distribute the dividends that they earn. That's just one part. And let's look at that first part. Let's take a look at their top 10 positions right now in JEPI. Those include United Health, the Hershey Company, Progressive Corporation, ExxonMobil, Bristol Myers Squibb, AbbVie, PepsiCo, Eli Lilly, Coca-Cola, and the Travelers Company. In all, JEPI has 125 positions. So that's the first part of JEPI, is owning high quality dividend paying stocks. The second part happens to be the premium part of it. It is the JP Morgan Equity Premium ETF. And what the premium is a strategy in where they sell covered calls against the positions that they already own. So let's use United Health, for example. The company owns many shares of United Health. What they do is sell long-dated covered calls and collect a premium on that. That is the way that they're able to juice up the distribution yield. And those juicy distributions are paid out monthly. On the year, shares of JEPI on a total return basis are down just 3.6%. So if you're looking for higher yield, less share price appreciation, then JEPI is definitely the ETF to consider, plus they pay that nice juicy monthly dividend. So there we have 3 monthly dividend paying options for you to consider for your portfolio. We have 2 REITs with Realty Income and Stag Industrial, and then we have an ETF option with JEPI. Let me know down in the comments section below which of these 3 you prefer for your dividend portfolio. And again, I hope you enjoyed the video, and if you could hit that like button, subscribe to the channel, it'll be greatly appreciated, and we'll see you in the next video. Take care.